Hello, and welcome to Portfolio Matters, weekly markets checklist, week 147. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Well, I'm afraid this week you've just got me. Richard is on his yacht and has managed to forget his laptop. Normal service resumes next week. So, news this week. Well, we had lots of interesting macro data. The UK slipped into a technical recession in Q4, with Q4 GDP coming in at minus 0.3%. which is much worse than expectations. We'll go through all the UK data in a minute. Japan has also slipped into a technical recession in Q4. Now, we also had UK and US inflation data. Now, UK inflation came in soft, and it looks like the UK is on track to hit its 2% inflation target by mid-year. In the US, inflation came in hot, and there are worrying signs that US inflation may be persistent and indeed resurgent. We'll go through that in some depth. In the EU cut both its inflation and growth forecasts for 2024. It now expects inflation to average 2.7% and growth 0.8%. That's downgraded from 1.2%, so quite a significant reduction in EU growth expectations. Drought in West Africa has caused cocoa prices to surge to record highs. I hope you all bought your Valentine's Day chocolates early. And finally, in the US shale patch, Diamondback Energy has bought Endeavour Energy for $26 billion. Now, that is quite important because the continued consolidation in the US shale patch means that there are fewer independents and there are more majors, and the majors tend to stick to their development plans rather than reacting to prices, and that makes the shale patch less of a swing producer, and that is good for the oil price long term. Okay, some charts. Well, this is the cocoa price, and it's rivaling Nvidia, shooting through the moon. After the latest inflation numbers, the market pushed back its expectations for when Fed rate cuts would start, but you'll see that it's still pricing in 4 rate cuts by the end of this year, and then a further 3 in 2025. After the latest inflation numbers, the probability of no landing is rising, i.e., the Fed never cuts rates. And the US economy continues to grow at a decent pace. But as an example of just how volatile and febrile markets are at the moment, this is the share price of the UK chip designer ARM Holdings, which is listed in the US. And its share price surged by 30% in one day, and then over the course of the next 2 days entirely retraced that gain. So what happened was it reported decent quarterly earnings, and there was excitement over its potential to enter the AI market. But then the market came to its senses and realized that ARM designs CPUs, i.e. central processing units, rather than graphical processing units, which is what AI needs and what NVIDIA designs and manufactures. So the AI froth came out of the ARM share price, and shares were back to where they started. This is Japanese GDP. It's now suffered 2 quarters of negative growth and is therefore in a technical recession. And this is UK, where GDP contracted by 0.3% in December, and all sectors of the economy were in decline. And that meant that the UK is also in a technical recession. Now, today we have had UK retail sales, which bounced back from their weakness in January. But frankly, that rather looks like the ONS has got its seasonal adjustments messed up. The UK Statistical Office is not doing terribly well at the moment. And on to this week's economic data. And quickly, a summary of where I think we are. Well, the UK economy is in a technical recession, but showing signs of bottoming. The EU economy is in a technical recession and showing few signs of recovery. The US economy is strong, and there are signs it may be strengthening, although the latest data shows that US consumers actually pulled in their horns a bit in January, and we have been talking about excess consumer savings in the US for a long time now. Are excess savings finally being spent and running out? Finally, in China, we have no new data this week, but the Chinese economy is weak and it's very difficult to tell its true condition. And onto the UK, well, we had a lot of UK data this week. The Q4 GDP numbers came out as the UK economy having contracted by 0.3% in Q4. That was worse than expected and is the second quarter in a row in which the UK economy has contracted. We are now in a technical recession. So year on year, the UK economy fell by 0.2% in the year to Q4. Month on month, UK GDP fell by 0.1% in December, and that was slightly better than expectations, but November's number was revised down to plus 0.2% from plus 0.3%. Now, we also had the National Institute of Economic and Social Research's GDP tracker for January, and that came in at minus 0.1%, and they downgraded their calculation for December to minus 0.3%. So the UK economy is not doing very well at the moment, despite strengthening PMIs. Year on year, the monthly numbers show that UK GDP was flat at 0 in the year to December. Now, one of the puzzles with the data is that we have been reporting that the PMIs have been strengthening. So the bars are monthly GDP, and you'll see that there appears to be only a weak correlation, if there's any correlation at all, between the composite PMI and GDP, particularly if you look at, say, mid-2023, the composite PMI showed actually decent strength, and the UK economy, according to the PMI, should have been growing at around trend. But according to the GDP numbers, it was close to recession, not growing at all. So currently, the composite PMI is not a very good guide to the strength of the UK economy. So the latest UK GDP numbers show that the UK economy is now only 1.2% bigger than it was 4 years ago, although that disguises quite big sectorial shifts in the economy. So we've had a big drop in the energy sector, contribution to the economy. And that's not really surprising given the big falls in gas prices over the last couple of years. And we've had strong growth in IT and the services sector. Pause, take a look. Now, what is particularly worrying about the GDP numbers is that if you look at GDP per head, it has now been contracting for 7 quarters in a row, and it fell 0.7% in 2023. So the UK economy is only growing by more people entering the workforce. We're doing more work rather than working smarter. And economic activity per head is falling. And compared to other countries, the UK has been underperforming since 2019. We are the light blue line, doing worse than the Eurozone and much worse than the US. And we are also underperforming our pre-COVID trend. Labour productivity contracted by 1% in Q4, and that is a very poor number. Construction orders year on year fell by 30% in Q4. So tighter monetary policy is absolutely having an effect on the UK economy and the construction sector. And because orders take a while to lead through to actual activity, that fall in orders will be a continuing drag on the UK economy in the coming quarters. And construction output fell by 3.2% in the year to December, and that was substantially worse than expectations. Industrial production, however, was better in December, beating expectations by a decent margin and up on November. Year on year, industrial production is now in expansion, and that was much better than expectations. So it seems that the manufacturing cycle may have turned, and that is good news for the economy. We also had inflation numbers in the UK, and they were much better than expected. So last January, so in January 2023, the month-on-month number was minus 0.6%. And this January, it is also minus 0.6%. So that meant year-on-year inflation was unchanged. And if we look at the monthly numbers, you'll see that in the last 8 months, UK and CPI inflation has totaled 0.1%. But there were these 4 months, February, March, April, and May of 2023, in which inflation totaled 3.8% last year. Now, as we move forward through 2024, those high CPI prints from last year will progressively fall out of the comparison window. And hence, unless we get a resurgence in inflation, and there is currently no sign of that in the UK, then the UK is very much on track to hit the Bank of England's 2% target by mid-year. Now, the caveat to this is that last year, the seasonal pattern was for a fall in inflation in January, perhaps due to the January sales, and then a big pickup in inflation over the next 4 months. Now, let's see what happens. So this is annual inflation, which was steady at 4% in January, missing expectations. The expectation was that it would rise to 4.2%. Core also came in better than expected. It was expected to fall by 0.8%, a big fall. In fact, it fell by 0.9%. And you see the same pattern in core as you do in headline CPI. So over the last 8 months, core has only summed to 0.8%. And as the February, March, April, and May numbers fall out of the comparison window, so core is also on track to meet the Bank of England's 2% target, unless we get a resurgence in inflation. And annualized core is at 5.1%, but as you've just seen, that is almost entirely due to the inflation we saw in February, March, April, and May of last year. RPI beat expectations, coming in at 4.9%, down on December and below expectations. Month on month, it was minus 0.3 versus minus 0.1 expected. Now, that means that compared to its other countries, UK CPI is high, but not looking so much of an outlier. Services inflation, though, in the UK is still high, although it did fall 0.8% month on month. The year-on-year number remains far too high for the Bank of England's comfort. And these are the contributors to the month-on-month change in inflation in the UK. And you see there was actually quite a broad-based deflation. We had falls in furniture and food and non-alcoholic drinks, falls in the prices of clothing and alcohol and tobacco. Even the prices of hotels and restaurants fell. But that was offset by rising fuel prices and housing and household services. Now, what's in housing and household services? That's rents, maintenance, contents insurance. And I think what was happening there is that contents insurance has been reset higher as of January, and hopefully that is a one-off. But the UK inflation statistics are not seasonally adjusted, and Simon French on Twitter thinks that if you seasonally adjust them, they would be higher. The number would be higher. So we'll just have to wait and see what UK inflation does over the coming months. The good news is producer price input inflation continues to fall. Month on month, it was minus 0.8% in January, and that implies continued deflation in the UK, or disinflation in the UK. Year on year, it's minus 3.3%. Output inflation also fell, down 0.2% month on month, and down 0.6% year on year. The difference between producer price input and output inflation should be company profit margins, and that implies company profit margins have risen. UK unemployment rate has been revised down. So according to the ONS, the UK unemployment rate fell to 3.8% in December, down from November and well below expectations. The UK employment market remains tight, and that's bad news for the Bank of England and its fight against inflation. The employment change in December showed that the UK continued to create jobs, another 72,000 jobs, slightly below expectations and down on November, but still good news. Average weekly earnings grew faster than the market expected at 5.8% year on year, although that was down on November, although the November number was revised upwards. Excluding bonuses, it also missed expectations, coming in at 6.2%. So UK earnings growth is slowing, but not slowing as much as the market had expected, and is still way too high to be consistent with the Bank of England's 2% target. UK job vacancies, according to the ONS, continues to fall, but falls slowly. And according to the ONS, there remain more job vacancies in the UK than pre-COVID. Now, I have had a look at the UK earnings data, downloading it from the ONS. And if you take the last 3 months, then you get, including bonuses, annualized pay growth of minus 2.4%, excluding bonuses, plus 2.6%. To look at the 6th month annualized, including bonuses, it's minus 0.3% annualized, excluding bonuses, 3.9%. So it would appear that if you take the more recent data, UK earnings growth is very much under control and compatible with the bank's 2% target, as long as we get some productivity growth. But as you've seen, UK productivity is currently moving in the wrong direction. Median pay ticked up in January, but growth again appears to be slowing. Number of payrolled employees in the UK continues to rise and is now at a new high, well above pre-pandemic levels. So according to the employment numbers, the UK economy should be growing and should be doing quite well, given that more people are working and therefore producing more goods and services. So how come, if the UK employment market is doing well, we have more people working and therefore producing goods and services, then why did the UK economy contract in Q4? That is difficult to understand. The implication is that the UK is losing jobs in high-value sectors and creating more jobs in low-value sectors. The UK unemployment count rose slightly in January to 14,000, which was above expectations and up on December. The December number was revised down, and that January number is perfectly fine. It's actually consistent with the pre-COVID period. HMRC payrolls rose in January by 48,000, much better than expectations, and the December number was revised up. Now, McKinsey believes that the UK jobs market is tight, but slowly cooling. You see the tightness indicator on the left here. They believe it is tighter than pre-COVID and has tightened in the last quarter. We look at the post-COVID period. The changes to the UK jobs market are really extraordinary. So there has been a net fall in the number of UK employees who were native British, i.e. born in the UK, by almost 1 million. There's also been a fall in UK employees who were from the EU. And there's been a big rise of over 1.2 million in the number of UK employees who were born overseas. So the UK economy is being propped up by immigration. And one of the reasons that we are seeing a tight labour market is the rise in long-term sickness post-COVID. So you are looking at the dark brown bars, and you'll see, compared to pre-COVID, we have had a rise of over 600,000 in people who self-define themselves as long-term sick. Now, this morning we had UK retail sales, and they came in at plus 3.4%, much better than expectations, and entirely reversing the fall in December. Taken together, they imply that over the last 2 months, UK retail sales have basically been pretty flat. It implies that the ONS has probably got its seasonal adjustments wrong. Year on year, UK sales grew by 0.7%. Reminder, that is nominal. So UK retail sales are growing slower than inflation. So this is the UK balance of trade in goods, and what a frightening chart it is. It shows that the UK balance of trade in December was minus 14 billion. That was slightly better than expected. You can really see the decline of UK manufacturing from the early 80s in this chart. Our overall balance was slightly worse than expected, but better than November. Now we had the ONS house price index, and that showed that the year to December, UK house prices fell by 1.2%. Now, we have been previously showing you the Halifax and nationwide house price indices, both of which have shown strong price growth in the last few months. Well, both the Halifax and nationwide calculate their changes from the price of houses on which they are writing mortgages. And it implies that the Halifax and nationwide are writing mortgages on more expensive homes. But the ONS calculate that the price of the average house in the UK has fallen over the last 12 months. Citigroup Economic Surprise Index for the UK continues to be poor. The UK is underperforming expectations. The Indeed jobs tracker shows that the UK jobs market is tight but slowly weakening. And trueflation currently in the UK is 5.2%, which is up over the last week, but still well below the official numbers. And this chart from the OBR shows the expected path of the UK national debt. Reminder, we have the budget next month, and the Tories are proposing to cut taxes further. Well, we need to get debt under control, and currently the government plans show that debt is expected to increase as a proportion of GDP over the next couple of years and only fall towards the end of next Parliament as a result of cuts in government expenditure, which will be difficult to actually achieve. So, in summary, despite strengthening PMIs, the UK economy actually contracted in Q4 and fell into a technical recession. GDP per capita has fallen for 6 quarters in a row. The UK economy is not doing well. Inflation missed expectations in January and disinflation continued. The UK jobs market remains tight and unemployment actually fell to 3.8% in December. Bottom line, we're in a shallow recession, and the PMIs, which we report every month, seem to have been a very poor guide to the actual state of the UK economy. Good news is inflation is falling and appears to be on track to return to the Bank of England's 2% target by mid this year. Okay, on to the EU. We had very little EU data this week. So we had the ZEW Economic Sentiment Index, and that is a poll of professional economists and forecasters, and that bounced to 25 in February, better than expected and up on January. EU industrial production massively bounced back, beating expectations and rising 2.6% in December. The November number was also revised upwards. And that meant EU industrial production actually rose 1.2% year on year. Much better than expected, and a huge rise on the contraction in November. The Economic Surprise Index continues to rise sharply. The EU economy is doing better. So in summary, the EU economy is in a shallow recession, but showing signs of bottoming. Globally, we're seeing an upturn in industrial activity onto the US. So we had inflation numbers in the US, and we're going to take a long look at those, and they were worse than expected. So month on month in January, US inflation came in at 0.3%. That was worse than expectations. And year on year came in at 3.1%, down on December, but worse than expectations. Core came in at 0.4%, again, worse than expectations. Now, you'll see that the US has a similar issue to the UK in that it has this big block of inflation which occurred in February, March, April, and May last year. And since then, inflation has been lower. But the contrast is nowhere near as strong as in the UK. And actually, you'll see that more recent inflation numbers have been much stronger than in the UK. So year on year, US inflation came in at 3.9%, which was unchanged on December and worse than expectations. Now, last year, January inflation in the US was also poor, and that proved to be a poor guide to inflation for the rest of the year. And Robin Brooks of the International Institute of Finance is saying that he expects a similar pattern this year, that there are base effects in the US when lots of prices are reset in January, and he expects inflation to fade over the course of the year. And we have had a very, and when you look into the numbers, the rise in US inflation is in a large part due to a strange rise in owner's equivalent rent. So, which is the blue line here. And it's diverged from the rent of primary residences in a very odd way. So owner's equivalent rent is the hypothetical amount it would cost a property owner to rent his own property. And what's really odd is that rent indices all continue to decline. So the Zillow rent index is the blue line, advanced 13 months, and because there are huge lags in OER, as we've discussed many times, and you'll see that both that and the CPI primary rent indices are declining, and then OER has shot up. Very odd, and suggests that is just a noisy piece of data, bad data point. And the Bureau of Labor Statistics new tenant rent index is falling sharply. So that suggests rent of shelter should continue to decline in the coming months. So owner's equivalent rent is part of services inflation, and service inflation is a problem. So if you look at core services, it's high and not falling. Super core, which is services inflation excluding houses, is rising in a way that is not compatible with the return to the 2% target. Here we have core services ex shelter rising in a very unpleasant manner. Supercore inflation is largely transport. So resurgence in, and we're seeing rising oil prices, and that is not good for supercore inflation. But year on year, there's actually very little inflation in the US. The And what inflation there is almost entirely due to owner's equivalent rent. So Goldman Sachs think that the January inflation number was strong entirely due to the January effect and this weird spike in owner's equivalent rent. And inflation is on track to hit the Fed's 2% target. And if we exclude shelter, then there's very little inflation in the US, and it has been below the Fed's 2% target for 8 months in a row. But all the regional Fed's inflation measures rose in January. So median, trimmed mean, and sticky core inflation all rose sharply. If it hadn't been for a fall in gasoline prices in January, then the January CPI print would have been even worse. The good news is US inflation expectations remain well anchored and are back down to their pre-pandemic levels, or the upper end of that range. Broad measures of inflation expectations are all on a downwards path. Pause, take a look. Import prices, however, showed a strong bounce in January. Year on year, they are still negative, but rising. Export prices also showed a strong bounce in January. Year on year, export prices were minus 2.4% in January, but that deflation in export prices is disappearing. Retail sales for January were a surprising and big miss. So month on month, US retail sales fell by 0.8%. And year on year, retail sales were up only 0.6% in January, well below expectations and well down on December. Are we finally seeing the US consumer running out of excess savings built up during the pandemic and cutting back on expenditure? Manufacturing output showed surprising weakness in January, down 0.5% month on month and down 0.9% year on year. Now, reminder that in January, we were reporting that both the ISM and the S&P Global manufacturing PMIs bounced sharply, but output actually fell. So again, it seems the PMIs are not being a very good guide to what's actually happening in the economy. So here you see the US manufacturing PMI, which is the dotted line, rose into expansion territory in January. And now we have the actual output numbers showing that output contracted from the manufacturing sector. Industrial production also fell, down 0.1% in January, much worse than expectations, and was unchanged year on year. In the US, industrial capacity utilization, which is the brown line, continues to fall. But we are seeing continued growth in manufacturing jobs in the US, which is extraordinary. Why are companies adding jobs when they have excess capacity? The National Federation of Independent Businesses, i.e. small businesses in the US, its optimism index declined in January, below expectations and below December. So small businesses in the US are not seeing improved conditions. And now last month, we had this big divergence between the regional Fed's manufacturing indices, all of which showed sharp drops, and the PMIs. Well, it seems that the Fed's manufacturing indices were a much better guide to what was actually happening in the economy. Now, this month, they bounced back sharply, but the Empire State manufacturing index, which describes manufacturing conditions in the New York district, was minus 2.4, which was much better than expectations and a huge bounce back from January. Philadelphia was plus 5.2. So Philadelphia returned to growth, although it's a very noisy chart. National Association of House Builders Housing Market Index rose to 48. That beats expectations. And the Johnson Redbook retail sales, having been decently positive throughout January, this week fell sharply to 2.5% year on year. So is that further evidence that the US consumer is finally cutting back? 30-year mortgage rates are rising again at 6.87%, and the mortgage market index is therefore falling back to even more depressed levels. Initial jobless claims missed expectations, and there's no real rise in initial jobless claims. Continuing jobless claims are rising, but not by much. Something to watch. One of the reasons that we're not seeing an uptick in unemployment claims is that there has been a big rise in retirement. So in 2023, we've seen a big rise of over 1 million in US employees retiring. The Dallas Fed's weekly economic GDP estimate for the US has ticked up. They now think the US economy is growing at 2.3%. The Atlanta Fed's GDP now is stable at 3.4%. So real-time estimates of how the US economy is doing seem to suggest it is growing pretty strongly, frankly, and there's not slowing, no problems. Economic surprise index continues to rise and is at 47. The US economy continued to surprise the upside. But the jobs market does appear to be slowly slowing. The number of job postings on Indeed is drifting downwards. US true-flation is at 1.78% and falling, although they appear to have completely revised the entire data series. Last week, I was reporting it was at 1.48% and falling. And there does appear to be a decent track record of true-flation predicting the path of US inflation. Pause, take a look. And that means that US inflation should continue to fall in the coming months. The Atlanta Fed wage tracker continues to decline, is now at 5%. So US inflation a surprise to the upside, and we're just going to have to wait and see what happens from now. People who are bearish about inflation will say that it is due to the strange spike in owner's equivalent rent and the January effect, but people who think that inflation is resurgent will point to persistent and rising services inflation and a tight labor market. Let's see what happens. Trueflation has proved to be a good guide for US inflation, and that is falling. Manufacturing activity in the US fell in January despite improving PMIs, as did retail sales. The bottom line is all the data suggests the US economy remains strong, and the manufacturing sector appears to have bottomed. On to China, no new data this week. So we've just got one chart, and this is from The Economist, and this shows the square footage of new housing starts in China. And you see there's been an absolutely enormous fall of over 50% in the last 3 years. So there's no recovery in the Chinese residential housing market, and that has previously been a huge driver of Chinese economic growth, and that has disappeared. So going forwards, I think China will have a structural drag from the lack of continued property investment. And on to one chart. Well, do you remember the meme stocks? AMC was a cinema chain whose share price shot through the roof. It was heavily indebted and had a failing business model, essentially. Well, since the peak of the meme stocks, its share price is down 99%. Now, I recently read a book on the whole meme stock bubble. And while all the Reddit crowd were driving up the price of AMC and other stocks with options buying, Wall Street was making a fortune, and insiders in the targeted companies were benefiting enormously. So the management of AMC and other companies were exercising stock options, selling their shares at the overpriced share price, and issuing equity to try and keep the companies going. So the main beneficiaries of the meme stock bubble, whose proponents said they were sticking it to the guy, well, the guys in the form of company insiders walked away with all the cash. Thank you very much. And the Reddit crowd are eating losses of 99% from the peak. In the end, the fundamentals always win. And on to inflation watch. Well, we had data from the UK and the US this week. So in the UK, CPI is at 4%, core is at 5.1%, RPI is at 4.9%. The path is generally downwards. US CPI fell to 3.1% in January, core is at 3.9%. Now, this is the latest Bank of England inflation forecast, and UK inflation is undershooting the Bank of England's forecast. And again, January inflation undershot forecast. So the Bank of England now expects UK inflation is on track to hit its 2% target by mid-year. It will then bounce back later in the year before drifting down below the 2% target if UK interest rates remain at 5.25%, i.e., the Bank of England will at some stage need to be cutting interest rates, or UK inflation will go below target. In the US, used car prices continue to decline, and that's good news for inflation. Food prices everywhere continue to fall, including food at home inflation in the US. Producer price inflation in the US continues to decline and has a good correlation with service inflation. Now, currently, services inflation is ticking up, but inputs are falling. And so you would hope that service inflation should fall over the coming months. Small companies in the US are planning to raise wages. Now, we've also seen earlier the business optimism charts for small business in the US, and they are not optimistic. So a tight labor market in the US means that wage pressures have not gone away, although the latest data suggests that those compensation plans are falling back again and may have peaked. In Germany, price expectations in services are rising. And so, again, there are risks that inflation, which is currently on a downward track, will bounce back later in the year. And in the EU, wage growth remains too high, although it is falling, but slowly. Reminder, we previously talked about how the ECB thinks that only around 40% of wage negotiations have yet been agreed for the coming year. And so it doesn't think it's got enough data on the path of wages to start cutting interest rates. Wages are too high for comfort. And this is very worrying. This is the Economic Cycle Research Institute's, its future inflation gauge is rising again sharply. And that tends to lead inflation. So they're suggesting international inflation will surge back again later in the year. And that will undermine the case for rate cuts. US gasoline prices are rising again. And this is US trucking prices. And over the course of the last quarter, there have been shown quite a sharp rise, despite the fact that fuel prices over that period fell. But a growing number of countries are actually reporting deflation, while the number of countries reporting very high inflation continues to collapse. So overall, there's no question that we are currently in a period of disinflation. In summary, we are currently seeing disinflation in the UK, Europe, and the US, but there are worrying signs that in the US, inflation is persisting and may even be resurging. We'll just have to wait and see what the data does in the next few months. On to the granolas. And thank you very much to Discord member Simon W. for suggesting this. So it's not just a breakfast cereal. Goldman Sachs have created a group of 11 high-quality European growth companies who, they say, have matched the performance of the Magnificent Seven since January 2021, i.e. the bottom of the pandemic. Now, who are they? Well, you can see that Goldman Sachs have rather tortured the acronym to get to granolas. And there is a general bias towards healthcare. So GlaxoSmithKline, the UK listed pharmaceutical company, Roche, the Swiss healthcare and pharmaceutical company, ASML, the Dutch semiconductor manufacturing company, Nestle, Swiss Foods, Novartis, Swiss healthcare, Novo Nordisk, the Danish insulin manufacturer whose share price has shot through the roof on the back of its Wegovy obesity drug, L'Oreal, French cosmetics, LVMH, French luxury goods, AstraZeneca, British pharmaceuticals, SAP, German software, enterprise software, and Sanofi, which is French healthcare. So let's look at the share prices. Well, this is GlaxoSmithKline, and you'll see that its share price has done well from its bottoms at the lows of the pandemic, but long term, its share price has gone precisely nowhere in over 20 years. This is Roche, and actually, it's having a bit of a terrible time at the moment. Again, shares have done very little in 15 years. ASML, on the other hand, its shares have gone through the roof as it has a monopoly on the latest extreme ultraviolet semiconductor lithography machines. Nestle, again, shares not doing terribly well recently, actually. Novartis, shares really going nowhere. Novo Nordisk, going through the roof on the back of the obesity drug. L'Oreal, actually having a good run, and that is a very good long-term chart. LVMH, luxury goods, doing very well. AstraZeneca, actually doing much better than Glaxo, and shares on a general upward path, I'd say. SAP, volatile, but currently rising as everywhere software companies are doing well. And Sanofi, shares going nowhere and really unchanged in the last 20 years. So in a low growth environment, Goldman Sachs are saying they expect the granolas to outperform. But this seems a very strange grouping, frankly. The fact they're saying that the recent performance matches that of the Magnificent Seven is only due to a couple of its constituents, SAP, ASML, and Novo Nordisk. Many of the others are going nowhere at all, and case of Glaxo in particular, haven't gone or anywhere in a long time. And why would they expect them to do well in, and why are they expecting that to change in the coming years? Okay, on to recession watch. And frankly, very little of it. The yield curve has turned back down, has now been inverted for a record 473 days. So is the yield curve finally going to get this one right? It has proved to be a very good forecaster of recessions, but it's got this one wrong. Credit conditions in the US remain poor. They did appear to tick up recently. And job openings in the US are falling, although the jobs market remains tight. Their hiring plans also continuing to fall. UK brick deliveries, well, we saw earlier that UK construction new orders fell 30% year on year in Q4, and here you can see the effects of that, brick deliveries falling sharply. Default rates in the US have started to rise. Everywhere, people are no longer expecting a recession in the US. But the labour market is cooling. We've just seen that actually, despite rising PMIs, industrial production actually fell in January in the US, and retail sales had an unexpected fall. The EU and the UK are in technical recession already. Okay, and on to, is there a correlation between equity and bond yields? Now, I've talked about this many times. The fundamentals would suggest that there should be a strong link between treasury yields and equity yields, because as bond yields rise, so investors will move out of lower yielding equities into higher yielding bonds, and there should be an arbitrage between the two, particularly between index linked yields and equity yields. And you'll see, this is from week 106, that historically there does appear to have been a decent correlation between the two, but that has broken down over the last 18 months. And we were then saying, this is a year ago now, that we'd expect that gap to close. So either bond yields to fall or equity yields to rise. Now, as you know, that hasn't happened. Bond yields are down from their peak, but they are not falling, and equity yields continue to fall. So the gap between the earnings yield on the S&P 500 and treasury yields continues to widen. But long term, the data shows there is a relationship. It's just very noisy. So on the x-axis, you have the PE ratio of the S&P 500, and on the y-axis, you have US Treasury yields. and you'll see there is a relationship between the two. As Treasury yields rise, so the P ratio on the S&P 500 should fall. And that has an R squared of 0.33. So about 33% of the change in the P ratio of the S&P 500 can be explained by changes in 10-year Treasury yields. So in summary, I have previously stated that the relationship, there should be a sort of causal relationship between changes in Treasury yields and changes in the P ratio. The historic data shows that not to be the case. There is a relationship there, but it is noisy and unreliable. Higher bond yields do not automatically lead to lower equity valuations. And onto the average PE ratio. Now, last week, in fact, for many weeks, we've been talking about the PE ratio of the S&P 500 and giving you contradictory data. So how should you calculate the P ratio on the S&P 500? Well, the ideal way to do it would be to treat the S&P 500 as a single entity and sum total earnings and sum the market cap, and then P ratio equals the market cap divided by earnings. But that's not how most people do it, and that can lead to mistakes. So if you start, instead of using the sum of the earnings, you try and get to the average PE ratio of the S&P 500 by using the PE ratios of the constituents, then you can get bad numbers. So if you take just the mean of the P ratios in the S&P 500, you will tend to overstate the PE ratio. You need to take the harmonic mean rather than the arithmetic mean. Okay, so what's the harmonic mean? Well, the harmonic mean is slightly counterintuitive, and it is the best way of calculating the mean when you're dealing with fractions, averages of fractions. And so if we look at calculating the mean of three numbers, 4, 4, and 1, so the arithmetic mean, it's easy. Sum the three numbers and divide by the number of elements, which is 3. So you get an average of 3. That's the arithmetic mean. The geometric mean would be the root of the product of the three numbers, and that comes out at 2.52. Now, the harmonic mean is the number of elements, which is 3, divided by the sum of 1 over the number. And so here it is 3 divided by a quarter plus 1 equals 1.5 equals 2. And the harmonic mean gives the lowest answer because it gives an equal weight to each data point. Both the arithmetic and geometric means give a higher weight to the larger numbers. Okay, so how is this relevant to calculating the PE ratio? Imagine 3 companies, each of them with a market cap of 100 million. 2 of them have earnings of 10 million, and 1 of them has earnings of only 1 million. So their P ratios are 10, 10, and 100. If you were to take the arithmetic average PE ratio, then their average PE ratio is 40. The geometric average PE ratio is 21.5, and the harmonic PE ratio is 14.3. Now, we go back and start from fundamentals, well, total earnings are 21 million. Total market cap is 300 million. So its true PE ratio should be 300 divided by 21, which is 14.3. You see, only the harmonic mean of the PE ratios gives the correct answer. Only the harmonic mean gives the correct answer. So then what is the correct figure for the S&P 500? Well, for the S&P 500 as a whole, it is 21, and that's using 1 year forward earnings forecasts, excluding the 4 companies with negative earnings. For the Mag 7, it's 31, and for the other 493, it's 19, which is actually not that bad. And on soft landing watch. We've been covering this every week, but the employment index is not turning down in any way compatible with an imminent recession. Manufacturing new orders have turned up, and it looks like we have a bottom in the manufacturing cycle, and that should support growth. So you see new orders are moving towards neutral, although they're still, according to this chart from John Kemp, they are still below average. In Germany, manufacturing orders rose by an enormous 9% month on month in December. And US productivity is surging, and high US wages are affordable if those workers are more productive. And I thought this was a really interesting chart. This is new business formation in the US. And you'll see that new business formations have been incredibly strong over the period post-COVID. And the probability of a global recession has collapsed. Basically, nobody's expecting a global recession anymore. So the bottom line is, it looks like the Fed has achieved a soft landing, or maybe even no landing in the US. Global manufacturing appears to have bottomed, and that should support global growth everywhere. And onto other charts. Well, this is Chinese renewable energy investment, and amazing. In 2020, they set a target of reaching 1.2 gigawatts by 2030, and it looks like they're going to reach it in 2024. 6 years early, and only 4 years after they've set the target. So the energy transition is going ahead, although China is still burning a lot of coal. And on to good news. Well, while we talk about the climate, global plant growth has accelerated as carbon dioxide levels have risen. So plants are absorbing more carbon dioxide and turning that into vegetation, therefore taking it out of the atmosphere. Satellite data shows that over the past 2 decades, 55% of the world's land mass has shown accelerated rates of vegetation growth, whereas only 7% of the land mass has shown decline or browning. So net, climate change leads to more vegetation growth. That, they calculate, has boosted crop yields by up to 20%, which is good for food prices, perversely. It is not, however, anywhere near enough to fully offset the effects of human carbon dioxide emissions. And onto equities. So generally a decent week for global equities, up 0.8%, up 3.3% on the year. The all share was flat, down 1.9% on the year, still underperforming the world. Euro stocks, amazing, given the Eurozone is in technical recession, and frankly, there are few signs of recovery, up 0.8%, up 2.1% on the year. The S&P 500 up 0.6% on the week, up a very good 5.5% on the year. Bull market continues. The S&P 500 well above 5,000. The NASDAQ up another 0.7%, up 6% year to date. The Russell 2000 bounced back strongly. It's been struggling to maintain the 2000 level. Well, this week it bounced 4.1% and is well above 2000. Hang Seng has had a bounce. Has it hit a low now that the Chinese government has started to intervene and Chinese state entities have been buying the market? But it's still down 4.2% year to date. The Topics up 2.6%, up 11% year to date in local currency. Bitcoin, amazing, up 12%, up 22% year to date, and we're only 6 weeks in. Sterling down 0.3%, down 1.2% year to date. Euro down 0.2%, also down 2.7% year to date. Because the dollar index has been rising as the US economy shows unexpected strength, and that means US bond yields have been rising, supporting the currency. VIX spiked during the week, but fell back and ended up 10%, but is still at a very low number. Here's some charts relating to equities. Now, this is really interesting. Thank you to Draw It for sending this. The dark brown spikes are what Hussman strategic advisors call clusters of woe. And they're when various indicators start showing that the equity market is overextended. So pause and take a look. Now, we don't know how much of this is in sample or out of sample, but whenever you get these very extreme spikes in the cluster of woe, you tend to see a near-term peak in equity markets. So what Hussman advisors are saying is that the equity market is overextended and likely to see a setback in the near future. And while we're on that subject, everyone is super long equities. Asset managers are all in, basically. And the NASDAQ is being driven higher by fewer and fewer stocks. Last week, we talked about ownership of the FTSE 100 and how UK pension funds had been selling down their equities and moving into bonds, in part because of regulatory requirements. Well, thank you to Magnets for sending us this. This shows that the rest of the world has been buying UK equities. Now, as UK pension funds essentially have sold the vast majority of their equities, that forced selling should hopefully be coming to an end, and that hopefully will support the UK market from going forwards. Recent comments from the Fed suggest they still intend to cut interest rates later in the year. And if that happens, then the S&P 500 could well have a very good run because the economy is strong. Cutting interest rates will support economic growth and the 493 stocks that are not the Mag 7. When that happened before, the equity markets did incredibly well. Earnings expectations are rising. If you look at earnings per share in the US, you'll see that over the last 3 years, the Magnificent Seven have grown incredibly well, and the rest have done really not much at all. If the economy starts to recover, if we get a broadening economic recovery in the US, then that will change, and that should be very good for the rest of the market. And The most crowded trade is currently the Mag 7. And supporting Hussman Advisors analysis, insiders are selling out in a record fashion. Talked about China bottoming. Well, Chinese companies are buying back their own shares at a very fast pace. Is that they've been ordered to in order to prop up the market? We ask ourselves. And while we talk about equities, let's briefly look at the great crash of 1929, because in 1928, the Fed raised rates from 3.5% to 6% and cut its holdings of US Treasuries by 75%, i.e. it did QT. And the Dow rallied by 87%. Sound familiar? But then it didn't. Ultimately, the expectations, reminded the big bubble was driven by overexcitement about new technology such as radio, and ultimately it proved to be a bubble, and when it burst, equities crashed enormously. That will not happen again because the Fed made huge mistakes and liquidity conditions tightened enormously. The Fed, if there was ever another crash, the Fed would act to loosen liquidity conditions to stop us having a Great Depression. But I think, and we'll do something on this next week, the share prices of some of the tech companies are just unsustainable. And dodgy chart of the week, just saying. There's a 94% correlation between the S&P 500 now and 1929. Okay, on to commodities. Summary this week. Well, oil prices continue to rise on the back of continued tensions in the Middle East. Natural gas prices falling everywhere. That's great for Europe and our fight against inflation. Not so good for US natural gas producers. And the uranium bull run appears to have paused. In industrial metals, we've had a small bounce from last week's falls, but we're still down on the year. Tin, however, had an enormous bounce, and tin is mainly used in chip manufacturing and electronic circuit boards. So is that a sign of a bottoming in the global chip cycle? Finally, precious metals mixed. Gold was down, silver was up, palladium bounced hard. So energy commodities. Well, Brent was up 1.6% on the week and is well above $80. WTI up 2.5% on the week. Numbers specific to the oil market. Well, in the US, we've had a build, actually. We've crude inventories built by 6 million barrels. If you include the SPR, and you see they are slowly refilling the SPR currently. US crude production is at its recent high of 13.3 million barrels. There's no change in the Baker Hughes rig count. Now, in January, OPEC were meant to cut production by 500,000 barrels a day. And according to S&P Platts, they only cut by 340. And it appears that Iraq, Algeria, Oman, and Kuwait did cut. But if we look at Iraq, despite its cuts, it is producing 270,000 barrels a day more than it should be doing according to quota. And Gabon, Iraq, and Kuwait and the UAE are all producing more than they should. Saudi Arabia and Algeria are the big ones that are actually complying with their quota. Of OPEC Plus, Kazakhstan was also meant to cut, and it hasn't. Its output is unchanged, and it's producing almost 100,000 barrels a day more than it should. OPEC compliance is not great. And as a group, the OPEC 10 are producing 340,000 barrels a day more than they've agreed to. Now, Rory Johnson of Commodity Context thinks that the cuts were even more disappointing and that they cut by only 240,000 barrels a day rather than 340,000. If you're interested, pause, take a look. Now, oil demand is forecast to continue rising, and as we previously talked about, in 2025, supply is meant to catch up, meant to keep up, leading to a weak oil price. But going forward, where there's a lack of investment, oil prices are likely to rise. And consolidation in the shale patch, which we talked about in the news, is likely to help that process. The fact that the majors are moving in means that all these wildcat drillers who were very sensitive to the oil price, well, majors are less sensitive. They will just keep to their production plans. Now, this is the US Strategic Petroleum Reserve. They have started refilling it, but very, very slowly. At current rate, it will take 14 years to get back to where they were. And European air traffic remains 9.3% below its 2019 average. So if we get a return to economic growth in Europe and the UK, then you can expect to see stronger demand for international air travel, and that would support the oil price. Moving on to natural gas, Europe is having a mild winter. The storage is full, gas prices are falling. And you'll see that despite the war in Ukraine and Europe cutting its consumption of Russian gas, the European natural gas price is back down to, admittedly, the top of its pre-pandemic and pre-Ukraine war range. Very good for EU inflation. And one of the reasons is we have become more efficient in our usage of gas. We look at the EU7, i.e. the biggest countries in the Eurozone, then their gas consumption is running at 19% lower than in 2021. UK natural gas futures down 8% on the week, down 23% year to date, again at the top of their pre-Ukraine war range. Great news for UK inflation. US natural gas prices, terrible, down another 13%, down 36% year to date. Mild winter. US natural gas producers really need those new LNG liquefaction plants to come online so they can export some of this very cheap gas. Coal going nowhere, down 0.8% on the week, down 18% year to date. Uranium, is that a near-term peak? Down 2.8% on the week at 103, still up 13% year to date. And onto industrial metals. So this is aluminium, had a small bounce back from its falls last week, but still down 7% on the year. Cobalt going absolutely nowhere. Copper bounced back, up 1.9% on the week, but down 2.6% year to date. Chromium flat on the week, going nowhere, down 4.5% year to date. Iron ore up 0.9% on the week, but has not had a good start to the year, down 9.3%. Lithium going nowhere. Neodymium going nowhere. Nickel up a bit on the week, up 1.6%, but really going nowhere. Tin, though, bounced back, up 7.8% on the week, up 7.1% year to date. Main uses in solder on electronic circuit boards. Ferrovanadium dead, but actually up 5% year to date. Zinc showing a bit of signs of life after falling heavily last week, but still down 11.5% year to date. Onto precious metals. Gold had an indifferent week, down 1.4%, down 2.3% year to date. Silver actually defied gold and bounced, up 1.4%, down 4.9% year to date. Platinum going nowhere, up 1% on the week, but down 7.8% year to date. Rhodium, dead as a dodo, down 1.1% on the week, and really has gone absolutely nowhere in the last 6 months. Palladium had a bounce, but again, the general downwards drift in the price remains intact. And onto interest rates. And this is the UK yield curve, not looking very good, disastrous for me, up on where it was a month ago, despite the UK economy showing, despite the UK inflation coming in below expectations and the UK economy in a technical recession, all of which means at some stage the Bank of England will need to cut rates. In the US, we've seen an even stronger rise in bond yields over the course of the last month as the US economy has shown resilience and inflation has come in higher than anticipated. So all that means that the gaps between the US and the UK bond yield curves have tightened. Now, what is the neutral rate? Well, in the US, it is still estimated to be at around 1% above inflation. So US monetary policy remains very restrictive currently, although the US economy seems to be doing just fine. In the EU, the neutral rate is estimated to be around 0%. So the current rates, interest rates of 4% are deeply restrictive, and you can see that in the performance of the EU economy. At some stage, when inflation comes under control, you can expect central banks to start cutting rates. Now, 1 year US inflation break-even rates have been rising strongly since the start of the year, and that is the reason for the rise in bond yields. So the bond market is worried that US inflation is resurgent and not under control. Now, what's concerning is that the Congressional Budget Office thinks that US 10-year rates are going to rise over the course of this year. And one of the reasons that interest rates that in the US have failed to slow the economy is that US corporations have locked in their funding from the pandemic at very low rates. And so they have not suffered from higher interest rates. In fact, higher interest rates means they're getting more on their cash balances, and so they've been net beneficiaries. So this is how this chart shows the change in net corporate interest expense in various regions since 2021. You see higher rates have actually been good for the US and for the UK. In the Eurozone, where a lot of corporate funding is from bank debt, there has been a small rise, but again, not enormous given the rise in interest rates. The monetary transmission mechanism for higher interest rates into corporate interest expense is broken in the US and the UK. Historically, US 10-year rates have tracked nominal growth rates. So higher growth plus higher inflation means higher 10-year rates, and that's exactly what we've seen recently. In order for the 10-year yield to come down, so nominal growth rates need to come down. So the US economy needs to slow and inflation needs to come under control. So over the course of this is the UK 2-year. Despite the falling inflation, the market is expecting UK yields, UK interest rates to average around 4.6% over the next 2 years. I realize there is a small term premium attached to that as well. But at some stage, the Bank of England can be expected to start cutting rates. It all depends on the path of UK inflation. And right now, that is on a strong disinflationary path. The 10-year rising again. All these yields are very correlated with the US. If we have inflation and high rates in the US, then UK yields will remain elevated despite the relative underperformance of the UK economy compared to its peers. US 10-year is rising again. That's not good news. German 10-year bond yield is rising despite the German economy being quite weak. But the Italian and the Greek 10 years are not rising. Okay, so concluding comments. Well, interesting data for the UK. The UK economy showed unexpected weakness in Q4, and the UK economy is in a technical recession, though showing some signs of bottoming. One of the interesting things about the weakness in Q4 is that we've been reporting rising PMIs in the UK, and the PMIs have proved to be quite a poor guide to the underlying strength of the economy. Inflation came in weaker than expected and seems on track to hit the Bank of England's 2% target by June. The next few months will be crucial. Currently, trueflation is not showing any resurgence in UK inflation. As long as that continues, I think we can say that UK inflation is on track to return to the 2% target. Earnings growth is high but slowing. The US economy remains strong, but there were some strange signs. The US consumer pulling back in January, and industrial production actually falling against expectations. The big concern, though, is inflation. Inflation missed expectations, and there are signs that the service sector inflation is persistent and may even be resurging. As we discussed earlier, we're just going to have to wait and see how much of the January numbers was anomalous due to owner's equivalent rent, which was odd, and the January effect. And finally, on to me. Well, I am having an absolutely terrible year as I am largely I'm actually almost exclusively in long-dated UK index-linked bonds. As bond yields rise, I'm getting killed. So I had another terrible week, down 12.5% on the year. Not much fun. But the UK 30-year currently yields around 4.6%. UK inflation is on track to hit the Bank of England's 2% target. If we get 2% inflation later in the year, then UK monetary policy is just inappropriate, given that we are in recession. Now, if you have UK inflation at 2% and bond yields, 30-year bond yields of 4.6%, then they are giving you 2.6% real. And if you're a UK taxpayer and you can get index-linked bond yields at 4.6%, then most of that being tax-free because it is a capital gain, then that is really attractive. That is difficult to beat post-tax. if you're a high rate taxpayer. So I fully expect bond yields in the UK to come down later in the year, but let's not kid ourselves. This has been an absolutely disastrous trade that I'm trapped in. And the economy has not done what I've expected, and equities have not done what I've expected either. So this has been bad. Anyway, I hope you're all doing much better than me. It's not difficult. Please, can you press like and subscribe to the channel? I apologize for the absence of Richard this week. Next week, I hope he'll be back and it'll be more fun for all of us. In the meantime, it's goodbye for me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.